2022, is it going to be boom or bust for the property market? This is one of the biggest questions we're being asked at the moment. Is 2022 the year you want to buy? Is it the one you want to sit on the sidelines? In today's video, you're going to find out if now is the right time to buy. We're going to look at some of the key property indicators you need to watch for, and we're going to review which cities are going to outperform in 2022.
So today, guys, we're going to run through an SMQ report by Lewis Christopher. Now, he's renowned in the industry. His research has been accurate for 2021. We're going to run through that. We're going to look at the leading indicators that drive property growth or drive property to go down. Now, this report was done in November, so we're going to give an updated view on what we're seeing on the ground level live from 2022. And you can get a copy of this report by Googling SMQ research and jumping on their website for the boom bust report. So Jaden, let's dive into the report and look into it.
Before we start this video, if you find it helpful in any way, do me a little favor and hit the like button. Or leave a comment below for the YouTube algorithm. Just a little gesture like that can make a huge difference to the channel. And if you haven't already, consider subscribing below. So thanks you guys, it really means a lot to us, and let's dive right in.
So starting from the top, his 2022 forecast is that house prices may peak sometime in the latter half of 2022. The report also says additional action is expected from APRA in 2022. So Nathan, wind us back to 2022. What did APRA do, and did it have an impact on the property market?
Yeah, we saw APRA change some of the servicing requirements by the bank, which is the interest rate buffer they put on when they do an assessment for an application. That increased so that it effectively reduced people's borrowing power by about 5%. We actually haven't seen a huge impact of this because it came in late last year. However, watch this space. It might subdue some of those crazy prices that is happening at the moment. APRA also introduced something called debt to income ratio, which pretty much meant that if you're lending more than 6 times your total income, the banks now make it a little bit harder to get the loan across the line.
Yeah, I've actually seen some of these impacts hit investors. So one of the big banks, I'm not going to say who, what we have seen is some screws being tightened in the background when the banks are assessing applications, in particular for investors. So a couple of the big banks now are really running the ruler over investors if they have 2 or more properties. Specifically, they're looking at property expenses. So really interestingly, we had a customer who had 4 investment properties, and normally the bank just takes the income of the investment property at 80 or 70%, and they say, the expenses are what they are. In this case, and moving forward, the bank has asked for actual tax returns. They've gone through the expenses, how much they spent on gardening, on rates, on electricity, on investment property, taken that from the amount, and it reduced their borrowing capacity by about 40%. It made a massive impact. I think that's another space where the banks are trying to get around APRA, directly getting involved and telling them, hey, you need to do this, this, and this, and being really prescriptive. The bank's saying, oh, we'll just do this in the background. We're going to slow some things down, and particularly from investors from getting over leverage, which we saw in the last 2007 boom, where people were buying 9, 10 properties in mining towns and then going bust and then calling the banks, saying that was your fault. I think there's going to be more there. But interestingly, like Nathan said, for first home buyers, it actually hasn't had a massive impact yet. Now, the other interesting thing with this report, and it's really important to keep in mind, is that when they're talking about the market, it's too general. The property market in Australia is like a jigsaw puzzle. There's all different pieces all over the place, and they don't all move uniformly. When they say dwelling prices may peak in the middle of the year, it's too general. You need to look at the specific properties and the areas which we're going to cover a bit later in this video. An interest rate rise mid-year or earlier could accelerate property price falls, while no rate rise will mean property falls will be kept to a base minimum, as property increasingly benefits from the tailwind of rising inflation. Again, we've started to see the impacts of increased fixed rates over the last 6 months. So 6 months ago, Nathan, you'd remember, what were the interest rates at that point?
Yeah, we're getting fixed rates from about 1.99%, 1.89%, and all of a sudden, in the last 4 or 5 weeks of the year, the fixed interest rates went up by at least 0.5%, 0.7%, and that had a lot to do with the bond yield markets and the swap rates, all factoring in that interest rates might rise in 2022.
So equally, they're saying here, if interest rates, the official cash rate does go up this year, it could slow things down in the property market. Repayments go up and costs go up. My opinion on this is it's not going to make a massive impact. Even if interest rates went up by 1%, we're still at historically low interest rates. The average interest rate over the last 30 years has been 7%. So even if they went up to 3%, your repayments are still pretty low. For example, if you're borrowing for a $450,000 loan at 3%, your weekly repayment's only $450 a week. It's still pretty affordable when you compare what the cost of rent is. They expect Brisbane to outperform the rest of the housing market in 2022 with strong interstate housing migration flowing out of Victoria and even New South Wales, which we've seen since the borders have opened late last year.
Now, Jade, we'll run through more details on each state, each capital city later in the video, which will give an actual prediction as to where the market might look like at the end of 2022. So Jade, now we're going to look at the key leading indicators that help us understand where the property market might go and what that means for you if you are actually looking to buy in 2022.
The good thing with these indicators is you can actually even break it down to suburbs in your area based on the ABS data. So again, the data we're looking at here is pretty general. It's across all of Australia. So if people in Sydney get property price wage, they get massive wage increases because of the Great Resignation, which is due to happen this year apparently, then it could mean that property price growth is going to go up because people got more money, they can spend more on property, they can afford to get more, etc. So Nathan, let's check out some of these key indicators. The one that you can see there is wage growth. So wage growth remained subdued in 2021 and below CPI, but numerous reports of labour shortages mean an acceleration in wages over 2022, which could be positive on property. So right now, wage growth is pretty subdued, but it's looking like it's going to go up, and potentially that's going to be a positive sign for property this year. Migration's really impacted wage growth in a lot of industries, in particular skilled migration. So in the IT and engineering industries where people would normally come over on a skilled entrant visa, they're having to rely on people in Australia who have already got that skill set. And it's not like there's more and more. So those people are getting higher wages, they're getting more wage growth, and there's more opportunity this year. Which actually leads to a common question we get asked, Nathan. If you get offered a new job, if you change jobs, is it going to impact your home loan? Tell us a bit more about that while we're on the topic.
Yeah, if you actually find that you get a new opportunity with a new employer, as long as you're full-time employed or you're in a part-time position, most banks are willing to accept 2 pay slips, as well as your background having industry experience. Some actually don't need that industry experience. So a good tip there if you are thinking of changing roles in 2022. So moving on to unemployment. Now, this is another indicator as to how property prices might move. Higher unemployment means that there might be people that can't afford their mortgage repayments or are going to sell their property, which means there's going to be greater supply than demand, which drives down prices. As we can see here in this report, unemployment rose to 7.5% over the peak COVID period and then went straight back down pretty quickly in October to 4.5%, back up at around that 5.25% mark now. It's looking likely that unemployment isn't going to increase anytime soon, especially with what we talked about before, wage growth being pretty stale. Unemployment is likely to stay the same. Now, the last indicator we want to look at is consumer sentiment. Jaden, tell me why consumer sentiment is so important, especially when we're talking about the property market.
Yeah, if you're feeling positive about life, about your work, about money, they're going to be more willing to spend, which helps the economy grow and things look better. So the more positive people are looking, the more likely they are they're going to look at properties and the market's going to be buoyant and look good. Whereas if they're feeling depressed and locked down, like you can see when consumer sentiment plunged sort of late last year, that's not going to be great. So it is improving. It's looking really positive as the lockdowns have ended. And I guess you're going to probably continue to see that this year as people can potentially look at traveling and moving, doing that sort of stuff back to resuming normal life.
Yeah, as we can see in the report, looks like in that 2020 phase where COVID peaked, consumer sentiment tanked, went down to a historic low. It's back up and it's looking pretty stable at the moment. Another thing to look out for is the national asking prices. This is where vendors have been aggressively lifting their asking price since March 2021. Most of that confidence has been for houses, whilst units have been treading water. It's really interesting to see that, how sharp the increase on vendors and their expectation on prices are.
So one area this has scared people are property valuations. So earlier this week I had a conversation with a home buyer that was looking at buying a property in Hornsby in New South Wales, and the price they wanted to offer on the unit was $50,000 higher than anything else that had sold recently. And they asked, well, is the bank going to have an issue with this? There's no recent comparable sales. What's going to happen? So Nathan, what are you kind of seeing in those situations? Are the banks and their valuers understanding that the property market's moving up and vendors are asking more and more money? What happens?
Yeah, interestingly, we've not been having issues with valuations. The banks are adopting the contract of sale and saying, well, hey, look, the market's determined this property is worth 50 grand more than any other property that's recently sold. we're going to accept that as what the market is now. So definitely not having issues with valuations on purchases at the moment. The interesting thing we're seeing a lot of success in is where people had purchased their property 6 months ago and we're revaluing it and being able to unlock hundreds of thousands of dollars of equity because of the prices increasing so drastically. So something that we've been seeing quite recently, which is awesome for clients that are wanting to get another property or invest or even release their guarantors or pull out equity to do renovations.
And on that, if you'd had a chat with a mortgage broker probably more than 3 months ago, it would be worth getting in touch with them to find out what your current borrowing capacity is. Because those APRA changes we mentioned last year, it could be a lot different from what you expected and even the conversations you had last year. So it's worth hitting them up, get in touch. If you don't have a broker, get in touch with us and we can help you out.
So I guess the last thing we want to look at for current indicators is national listings. So Jaden, walk us through this section here.
So national listings had been falling throughout the course of 2021 and eventually hit an 11-year low of homes for sale. The long-term average of homes is 275,000 compared to 215,000 up for sale, with an all-time high of 380,000, almost double. Lockdowns in Sydney and Melbourne affected the listings from mid-2021. Going forward, you could expect more listings available because hopefully there's going to be more choice available. It was definitely an issue we saw late last year where there just weren't enough homes for sale. And it's even kind of continued into this year where there's more buyers than sellers and the few houses that were for sale were getting fought over and people were paying, I guess, overs compared to the previous market. But like Nathan said, it's starting to sort of even itself out. I think there's going to find equilibrium this year where people are going to have more choice of stock.
Yeah, it's funny. We had a lot of home buyers looking to buy September, October, November. They really struggled to get in the market. And all of a sudden, December rolled around. I don't know if more people went on holidays or people stopped looking, but we had an influx of people coming to us that had been struggling for so long over those last 3 months and were successful. So whether there was more listings come on in December period, less people sort of going out to open homes and looking because they were winding up, pulling up stumps for the year, was something actually interesting we saw at the end of December.
So lastly, on auction clearance rates, after the lockdowns, Sydney auction volumes have taken off. As a result of the lockdowns, clearance rates dipped below 60%. If they slip towards 50%, it's going to be a big sign the market has peaked. Melbourne's auction clearance rates immediately jumped following the lockdowns, and the markets have been pretty volatile since all the lockdowns in 2020. So again, another easy indicator to keep an eye on. If auction clearance rates keep at that 60, 70, 80% level, the market's pretty hot. If they drop below, it looks like it's probably going to pull back.
And once again here, this is key indicators for Sydney and Melbourne. So once again, if you're not living in these areas, it's good to jump on ABS data. CoreLogic releases the reports each week as to the clearance rates where you can get an idea of what the market's doing in your area.
The last two indicators are housing finance approvals. After big rises in 2020 and early 2021, housing approvals have started to fall lower in late 2021, driven by falls in owner-occupied activity. First home buyers have slumped, and they're saying there's not many around at the moment, but investors are still holding the line. So the interesting indicator there is that good time to buy a house survey. It did drop in the latter part of last year. I think that was a combination of the lockdowns in Sydney and Melbourne. And like Nathan said, it was just depressing. There was no stock. People that we were working with locally here in Brisbane just couldn't find a break and a property for sale, whereas that seems to have turned definitely early in 2022.
And it's interesting, I think this report gives a really high arching overall view on what things might look like. On the ground level here, we're seeing still a lot of activity with first homeowners. We have seen an uptick in investors, interestingly, but definitely not really seeing a fall in that home buyer activity for first homeowners. So it's interesting that the report sort of overarching theme mentions that there's a slump in first homeowner activity. I guess that's across the board, but day to day, week to week, what we're seeing is that there's still plenty of confidence and plenty of first homeowners that are keen to get in the market. Okay, well, let's look at the drivers of the housing market in 2022 and what this actually might mean for you if you are interested in buying or even considering your options for the year ahead. So let's take a look at the past and what's happened and what potentially might happen.
So the big one is finance. That's going to make the biggest impact to the property market, and any tightening or squeezing of credit will have a massive impact on property growth in 2022. So like you can see here, APRA's intervention in October 2021. So looking at this historically, the big ones that made the largest impact was probably some of the action taken in December 2014, which included an increase in the serviceability buffer. So the serviceability test stood at a 7% flat rate. borrowers had to prove they had to hit a 7% serviceability index to happen. Today, that's at about 5.5% to 6%, depending on the bank. So it actually hasn't fallen that much, given that interest rates have come down several percent since 2014, which is kind of interesting to note. But it is also noteworthy that when those changes initially did come in, the market did start to slow down the year later. So it took until 2015 for those impacts to take bite. So it could be a similar situation with the ones that happened in October 2021. It could take a year for some of that to filter through. But like Nathan said, we haven't seen a massive impact on the property market and borrowing habits at this point, but keep an eye out on that. So the next driver is going to be inflation. And this is a big one that the Reserve Bank is looking out for, that they've said basically they're not going to put up interest rates until they see some inflation being driven up, and especially wage growth. So if you start to see headline inflation increase this year, if there's reports of wage growth going up, then you can definitely expect interest rates to go up sooner rather than later. And really the hedge for that, for you as a home buyer, is fixed rates. It's still the case that fixed rates are cheaper than the variable rates at the moment. So if you're looking at buying a home, definitely look at that to sort of lock in some of your risk. If you are concerned about interest rates going up, check out the calculator on our website. Like I said before, if you're buying a home for $500,000 with a 10% deposit, you're going to be borrowing $450,000 over 30 years. A 3% interest rate, weekly repayments are $440. If you're super concerned about rates going up, then do it at 4.5%, and your repayments go from $430 to $530. So can you afford that? Do you have enough buffer there? If not, maybe you shouldn't be buying. But like we said before, the banks are actually already factoring that in. They're working it out on a 5.5% to 6% buffer based on your after-tax income. So like you can see there, the repayments are $590 a week compared to the $430, which it is today. So just build that in when you're looking at buying a home.
The other key drivers of the housing markets are threats to disposable income. So I guess if inflation doesn't lift wages at the same level of inflation, then disposable income is going to be eaten away. So that, coupled with interest rate rises, would actually smash borrowers. So we have to be careful of this. It's probably something to keep an eye on. It's certainly not an issue at this stage, but another driver of the housing market at play there.
So in other words, if interest rates go up and no one gets a pay rise, it's going to be bad because everyone's income's going to be going backwards. But if wages keep rising, which is pretty well expected this year, it's going to be fine.
And the last couple are the equity markets. We won't run through that one. As well as COVID-19, which we're all pretty across now at the moment. It's all a little bit unpredictable. Anything can really happen. But right now, we're sort of seeing that it's all pretty stabilized on that front. Now, the last one, which is a really big one because there's no more international migration, is interstate migration. And we can see this graph here of the number of people moving interstate since 1981. But the main thing here is the interstate migration over the last few quarters. Now, Jaden, do you want to run us through this one here?
The net result after the back of lockdowns and all the trouble interstate, and even with the movement to remote working, is Queensland's picked up the lion's share of interstate migration, especially while international borders have been closed. Like you said, Nathan, Sydney and Melbourne aren't picking up all those people that are coming from overseas, the cheap labour, etc., etc. People moving up to Queensland, which they say could have some upwards price growth on property up here.
Now, looking at the graph here, we can actually see New South Wales and Victoria had a net minus in migration of 4,000 in the quarter of March 2021. In December 2020, they both had losses of over 5,000. So that's really interesting when comparing that with Queensland, where, as you said, Jaden, has had the lion's share of interstate migration. If you're looking at the net increase, has been 6,000 for the March 2020 quarter. It's been 9,000 for the December 2020 quarter and March 2021. The other states have all been pretty much neutralized. WA looks like it had some pretty good numbers coming through in March 2020. I think a lot of their lockdowns have made it hard for people to move across borders. So that hard line approach has really seen an impact, I guess, in their net migration. And looking at the graph on the bottom right here, the total number of arrivals and departures from international travelers, we can see there was a major drop and hasn't really recovered since COVID started.
Yeah, I think the key driver for a lot of that migration, though, has been affordability. And Brisbane's market's underperformed pretty consistently for the last 15 years compared to Sydney and Melbourne. So I think that'll be the thing. As the market starts to catch up, it may start to even out a bit more.
That coupled with remote working, Jaden, I think, Brisbane's affordability, and now the fact that people can literally work from anywhere has really helped see that migration to Brisbane and other states, for that matter, compared to, the great exodus of Melbourne and Sydney. All right, so let's have a look at Lewis Christopher's forecast and how it fared in 2021. So we can see here on this graph, in December 2020, they came out and predicted that there'd be house growth for Perth of 8 to 12%, Brisbane, as we can see, 4 to 8%, and so on and so forth. So they were predicting growth in every single capital city. Now let's compare that with the actual, and it's really quite interesting. The CoreLogic data suggests that Lewis Christopher's report was very accurate. He did predict a growth. In actual fact, the growth was a lot higher than their prediction there.
Yeah, these guys don't always get it right, but at least you got the right direction, because some of the banks, if you remember back, were predicting price falls potentially, and look where it sort of got to.
So I guess this is a bit we've all been wanting to understand, is where the market's going to go in 2022. Now there's a few different scenarios that Louis Christopher looks at. We'll look at all of them. So let's dive in and have a look at the forecast for 2022. So in all 4 scenarios, they're looking at whether the cash rate changes, whether inflation increases higher or lower, and if there is further intervention by APRA. As we can see in each example, there's slightly different variations of whether rates are going to change, whether inflation is higher or lower. But as we can see, looking at each state, we might start with Perth. They're predicting anywhere from a 2 to sort of 10% growth, depending on a number of factors. We can see it had a 16% growth in 2021. What do you reckon, Jaden?
As far as the scenarios are concerned, I'd almost be looking at scenario 2 or 3. Because if you look at some of the COVID outbreaks and what's happened overseas, it looks unlikely we're going to have further lockdowns this year. I guess wait and see. I suppose if you want to be conservative, let's go the middle scenario. And it's looking fairly positive in most cases. Sydney and Melbourne could be affected, coming back, 3 to 4% in the worst case scenario. But realistically, as we always say, it's about timing the market, not timing. So if it comes back next year and you're holding it for a 10, 15, 20-year time horizon, then it's all going to kind of even out at that time.
So it's interesting to see the forecast. Once again, going through each region, Brisbane, if we're looking at the second scenario here, 8 to 14% growth. Last year had a 22% increase. Darwin is predicted to have anywhere from a negative 5% growth to nil growth, based on the second scenario, if we're just looking at that, compared to this year's 19% growth. I guess Melbourne and Sydney, they had some pretty solid growth, 16% to 25%, and are predicted to really cool off this year by the looks of things, or have very minimal growth. Adelaide, looking still pretty strong, 20% growth last year with a 4 to 8% increase. Hobart, looking likely to cool down. It had a massive growth of 28% last year and potentially might even out with a little bit less growth or even neutralizing there, and followed by Canberra, looking like it'll keep going pretty steady there. So that gives us a good idea on the forecast of dwelling prices for 2022. Now, once again, they give a bit more information about their base case scenarios there. We won't run through that. It is interesting to see a little bit more details as to each capital city and what they see here. But Jaden, I guess from what we're seeing on the ground level and the confidence out there with first homeowners, investors, what is your view on this? What do you really see the market doing, by and large over the next 12 months?
I think overall it's looking pretty positive for property across Australia in 2022, especially in the Brisbane, Adelaide and Perth markets. Sydney and Melbourne, I think it could actually flip and be super positive if international arrivals continue to open up. So it's really going to put more people there. And the overarching theme is that stock is still limited. Interestingly, like we said earlier, the amount of properties for sale are comparable to 2010, and there's 3.9 more million people in Australia living now.
And I think on that Sydney and Melbourne point there, Jaden, even if prices go backwards a little bit, it might not necessarily be a bad thing. There's a lot of home buyers that are locked out of the market at the moment, so cooling off of the market might be actually a good thing for those that are wanting to enter it for the first time, or those that haven't been in the market for a little bit and wanting to get back into it.
Yeah, I'm calling scenario 3, or probably even more bullish, especially for the Sydney, Brisbane, Adelaide markets. I think you could see another year of 20% growth just off the back of having such subdued periods over the last 10 to 15 years in all those areas. Even Perth's been sort of bashed around, people locked down, the borders are closed, and I think it's going to be a similar thing to last year.
I think the other thing that we haven't included in this is if international migration opens up. We've seen a lot of relaxation around a lot of the COVID rules. If we start to see international migration come back in, we're going to see cashed up international buyers ready to get in the market for the first time and make the most of it, especially for the fact that they haven't been able to get here for the last couple of years.
So Nathan, 2022, the year to buy, what would you do if you're buying your first home?
I think as we said it before, it's not about timing the market rather than time in the market. So if you're looking to get in the market for 2022, yes, there's a lot of different factors going on. There's a lot of data you can look at, but if you've got the long-term view where you're going to be in the property or hold it for the next 10, 20, 30 years, we'd expect that over the short term, any ups and downs will all even itself out. And as we've seen in the past, we see that upward trajectory in growth in property across Australia. So that's it for today, guys. Leave a comment below as to what your views are on the market and where you think the market's going to be for 2022. And as always, at Hunter Galloway, we get home loans approved. So if you're looking for a mortgage broker and living in Australia, we can help. Visit us online at huntergalloway.com.au or call us on 1300 088 065 and we'll see you next time.